two key numbers we keep on watching. One is the defense spend, and other is the spend on electrification or power related capex.
Let's talk about the US trade deal now that the final details are out. Welcome to Moneynomics by Access Mutual Fund. I'm Shalini Gautam and I have with me our head of equity, Suresh Divakar. Today, me and Suresh will be discussing the key developments that have happened over the last few days, which is the union budget, the India-US trade deal, and also we will be talking about the earnings season this time. So, Suresh, let's begin with how has the union budget panned out and how does it impact equities?
Union budget is concerned if you look at the growth assumptions, first of all. The nominal GDP growth is expected to grow from 8% to 10%. That is, and along with that, all the numbers which are about which are there, in which two key numbers we keep on watching. One is the defense spend, and other is the spend on electrification or power related capex. So the growth in these two numbers was really good. It was in 50 to 20% region. So that is a good news. Apart from that, if you look at other headings, which is a fiscal deficit and the fiscal consolidation path, and the path we are on for last multiple years post-COVID, where there was expansion, there is definitely a good news on that. That is, we are on track for that path, and that gives good support for rupee and the overall stability of the market.
Let's talk about the US trade deal now that the final details are out. How do you see this boosting the markets?
As far as treaty is concerned, first of all, when it comes to market, direct impact is not much in my opinion, because the key beneficiaries, which is into gems and jewelry, or it is in textile, or certain areas where the combined impact on the, say, NSE 500 weightage would not be much directly, and that's where the direct impact in my opinion is limited on the market. However, the indirect impact, the indecision to decision. So earlier, since the tariff was high, and especially high on a relative basis compared to other countries, even today there is a tariff, but it is not relatively high compared to the other competing countries. So in that context, earlier the indecision was a real issue when it comes to someone who wanted to invest in India, that how it will shape up and pan over a period of time. So that indecision will get over, and you may see certain decisions being taken by the manufacturers, set of plant in India or expand in India, and associated FDI flows. So that is one aspect of it. As I said, it is a second derivative. It is not a direct beneficiary. On the other hand, along with reduction of this tariff, there are a couple of reasons. One is India's earning growth is expected to improve. The third reason is also about the fiscal stability, and because of which there is a possibility of rupee stability. And we can say FII flows also start to incur. At least in last few days post budget as well as this week, we have seen good flows from FII's point of view. I think the more it improves from here, it lends stability for rupee as well. As we understand that as far as rupee is concerned, there is no concern about fiscal deficit as well as current account deficit. The concern has been about FDI. So this deal, along with the multiple levers which I spoke, we may give fillip to the FI flows here.
How do you see the earnings season has been panning out so far?
Earnings season so far is generally, I would call out as usual. Only difference be not mainly earning cuts this time around compared to earlier. Growth trajectories are panning out in the manner what it has been earlier. So just to give you flavor, when it comes to financial services results, there has been a trend of lean compression, but now there is a stability on that front. The credit cost is getting stable or improving. The credit growth is improving. So there is a improving trend in that sector. Sectors like auto, they got a benefit because of GST, and that sort of getting reflected in the numbers. Sectors like IT, I don't think there is any revival losses so far. Even there are concerns about AI, but nothing is visible in the number as of now, as well on the quarter. So there is no change in that sector's outlook. Consumption-oriented sectors have shown broadly the results and trend. I don't think there is any change in the trend on that front. Overall, the trajectory of the numbers on a quarter after quarter basis. What we have seen that yes, these numbers were as low as 5 to 6% YOY growth. Now it is inching up towards 10%. And if the things remain like this and it credit growth improve further, then there is a possibility that it can move further to the 12 to 14% kind of number for the year to come. This is just based on the various brokerage estimates, and this is also based on the fact that there is a good base effect of last year.
Okay, so Shreyash, now the budget is out. The trade deal is also concluded. So what can going forward be the key triggers for the markets to look at?
Actually, these are sufficient enough triggers. So I think most of the big triggers which we spoke about in our 2026 outlook, they are now behind. Barring this, there is going to be election calendar for this year, and then there may be certain developments in US as well. But point is that broadly most of the key triggers are out. So I think that most of these being good as far as the outcome is concerned, I think the positivity to continue the market.
Okay. Thank you so much, Shreyash, for your views, and thank you to all our investors. Stay tuned.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.